All right, welcome. I am super excited to join you today live. We are going to be doing a deep dive into data-driven investing. We have a number of amazing folks today from a number of different firms, both venture firms as well as companies diving into venture investing and how to use data to better inform. And so let's kick things off. If you are new to the session or new to joining live, please share the stream with other folks in your network who may be interested in this. This is an experiment for us, and we'd love to hear and have more of you. So let's welcome to the stage a number of folks. We have a bunch of folks joining us today, and let's introduce ourselves. So my name is Greg. I'm one of the co-GPs of a firm called Founders Edge. We believe that founders are the unfair advantage to future founders. I've been investing for a number of years, both as an angel as well as running a program called Techstars Boston, which is an early stage accelerator. And I was drawn to the fact that there was just a lack of data in the early stage investing. I started doing a ton of research on this, including interviewing and surveying about 1,500 founders to try to identify the attributes of founder success. I'm excited to be joined here by Julia. Julia, you want to introduce yourself?
Sure. Hi, everyone. I'm Julia Whippo, co-founder and CEO of Moneyball. I started my career at Goldman Sachs in risk management, but left the firm to learn how to build businesses. Been building businesses and working in early stage investments since then. And my last business was a bank for private investors, specifically in the space. Now I'm excited to be exploring using AI to increase data availability between early stage investors and founders for better decision making on both sides.
Amazing. And Christian, do you want to introduce yourself?
Sure. I'm Christian Dorfer. I'm the founder and GP of an early stage AI fund called Defiance Capital. I started my career in finance too, with Pricewaterhouse. So used to building forecasts and building models using lots of data. I ended up becoming an entrepreneur. I founded a gaming company and a fitness tech company. And thereafter, I became a full-time investor. I was invited to set up and run the King.com Founders Fund after King was acquired by Activision, and have made about 75 seed stage investments so far. Yeah, that's me.
Awesome. And Adam, last but not least.
Yeah, hey guys, I'm Adam. I'm a partner at a fund called Episode One Ventures, where I lead a lot of our AI investing at the pre-seed and seed stages, and also build a lot of our tech, both on the predictive side and also the sourcing sides. We're a B2B SaaS fund. We like to be the first institutional investors into predominantly UK-based companies. Strong focus on highly technical founders working on very hard to solve problems. Our lead investor, sort of 1 to 3 million stakes. Prior to that was a PhD student at Cambridge, focused mainly on machine learning in a finance setting. And prior to that was a trader at JP Morgan, focused mainly on illiquid credit trading.
Awesome. Well, I know data is such an important part to basically every single business, but certainly I find it's been somewhat overlooked in early stage. And so as you've all looked at a bunch of data, what have founders and investors overlooked when it comes to the things that tend to be predictive for higher success? And so as either investors or founders, what are some of the attributes or some of the things that folks should be paying a little more attention to? Julia, you want to kick us off?
Yeah, sure. So something that I find that a lot of folks actually overlook, which is so critical, is actually the relationship between the investors and the founders. There's a research report that we're a big fan of that explores the impact of outcomes in startups when they have a positive relationship with their investor, results in more positive outcomes, which seems intuitive, but I feel like that is not necessarily taken into account by a lot of founders and a lot of investors, mindfully exploring how do I align with those investors and finding investors that you align with and finding founders that you align with, deeper than just a thesis fit. So shared values, shared belief systems, because the engagement of the investor and desire to participate and the transparency on the founder side that's built on that foundation of trust is directly influenced by that fit between the investors and the founders.
Christian, Adam, what do you guys think?
Well, when I decided to start my own fund, I was faced with the challenge of there are 1,000 early stage funds, 1,000 funds in Europe. If you're going to do a new fund, you got to make sure it's going to be one of the best ones, right? So I took a look at my existing portfolio to figure out what do my best performing portfolio companies have in common. And in my experience, interestingly, over 80% of the value comes from companies that were founded by immigrants, by female founders, by guys that didn't necessarily fit the usual, tick the usual boxes. So I thought that was really interesting. I dug a bit deeper, and I earlier this year released a report called the Unicorn Founder DNA Report, where my team and I looked at the backgrounds of all new unicorns in the last decade. And my personal, portfolio experience is actually part of a wider phenomena. So then I dug even deeper and started a podcast called Defying the Odds, where I've interviewed over 30 of these non-obvious unicorn founders to figure out, so what is it that makes them tick? And it all boils down to their level of motivation and not necessarily having a lot of choice. So hunger and the motivation of a founder is often what ends up setting them apart. And you see this in other disciplines as well, sport, for example. So, traditionally as VCs, we get bombarded with decks all the time, and you end up getting the deck, you're flicking through the slides. Maybe there's one slide with a few logos on the founders, but you don't really know the founders. So you end up throwing the baby out with the kitchen sink, if that's the right metaphor, so many times, because you're not looking for the founders that can make a difference. And as you know, at early stage, that first deck, what actually ends up getting funded and traction might be a completely different business. So focus on the founder, have your questions ready to determine if they have that psychology that's needed to build something that is venture scalable.
Adam, what about you? What do you think?
Sure. I mean, so we spent 3 or 4 years gathering as much data as we could for what we hoped would be pretty much every early stage founder in Europe. So we started off with a list of probably 25,000 founders who had started an early stage business over the last 10, 15 years. And the easiest data to gather is what school they went to, or whether they were a founder before, or what their experience looked like from a company perspective or a startup perspective. And a lot of these are typical variables in the sense that VCs screen for these, or assume that because someone went to Harvard or worked for Google, that they have a higher chance of succeeding. And in some cases they do, and there was some signal there, but we quickly realized that if you looked at the predictive power of these factors, there was a huge amount left on the table, where it would give you a slight benefit above just indexing the entire market, but there wasn't enough predictive power to turn it into some sort of tradable signal. And for us, we'd always felt that stepping away from the blue chip CV, that it was actually iconoclastic founders or unconventional founders that just did not fit any typical mold that ended up being the most successful. So it was tough to gather the data, but we started looking at things like how many countries a founder had lived in when they were younger, or how many languages they speak, or do they have obscure hobbies where everyone plays soccer or tennis, but how many people parachute out of airplanes for fun or free climb buildings for fun. We started doing natural language processing on tweets or comments or blog posts that founders had made to pull how neurotic or extroverted or agreeable they were. And we combined a lot of these things together, and we found that actually the behavioral or the personality-based features were more predictive than the typical features. And actually, when you work in some of these things that other people are looking at, you can uncover diamonds in the rough that a lot of VCs will completely ignore. So it took a lot of iterating to get there, but we found that the hard to get personality-based data and behavioral data was the most predictive.
That's awesome. And a lot of the things that you're saying definitely resonate with some of the research that we've been doing, and we're spending a little more time on the psychographics and kind of what is the motivation and how are people thinking psychologically about their entrepreneurship journey, because the entrepreneurship journey is so difficult. It does require kind of different mindset. And so certainly some of the data that you guys have observed, we've seen as well, immigrant founders tend to outperform. But the one that we've spent a little more time on is just experience, that a lot of the market tends to over-index on younger founders, having run Techstars previously and seen a lot of the accelerators, a lot of early stage programs tend to over-index on a youthful founder, someone who's more likely in their 20s, maybe early 30s. And the data really shows that the more successful unicorn level founders tend to start their unicorn ventures when they're closer to their 40s. And so thinking through how can you really apply some of those principles, some of those things that those early stage programs offer, but package them in a way that could be super useful for some of those older founders. But appreciate that. So let's dive into another question. So if you're a founder, you're starting your journey, you're kind of on that entrepreneurship train, what are some of the things that looking at the data that founders can do to improve their odds of success? Adam, you want to kick us off?
Yeah, sure. I think it's always a difficult question as to whether something is causal or whether it's just correlated. And if we find that doing a PhD increases your chances of raising a Series A or a Series B round, does that mean you go out and get a PhD and that means all of a sudden you're more likely to raise money, or is it actually indicative of something else behind the scenes and there are confounding variables? So I think it's tricky from that perspective. But I think in general, across most sectors and most geographies, as an easy first step, having some sort of operator experience, we saw almost unanimously was a help, just to be in a company that is, early on has raised money, is trying to build a product. You can see the things people get right. You can see the mistakes that people made, and it doesn't have to be for 5 or 10 years. And you don't necessarily have to have founded that business, but just being in an environment where you see people trying to scale a company and you have some sort of ownership and you're not spoon-fed anything, and you have to figure shit out by yourself essentially, was a strong predictor, but also something that I think everyone can get exposure to. And especially in the early stage of starting a company, I think it can help massively.
Julia, how about you? I know you've been both a founder and now looking at the data as well. What are some of those things that you see are helpful to founders to improve their odds? Oh, I think you're muted.
Thank you. Yep. So this is something that's only actually just starting to being studied. So there are studies that are looking at the psychometrics and the personality traits, but we're actually starting to see results in emotional intelligence and communication skills. So my number one advice would be take the time to start developing those skills, just as you would marketing skills or sales skills or technology skills. There are tons of skills you need as an entrepreneur. And I think that growing your emotional intelligence and your communication skills, with books, classes, workshops, and creating a corporate culture is actually going to have the highest impact on return for you.
Christian, how about you?
It's so interesting. For me, I think one point to really focus on as an investor and therefore also as a founder is distribution. I see so many great founders that are very passionate about something. Maybe it's even a big market, but they haven't really thought through how they're going to get distribution. They manage to raise some money. They get like initial product market fit maybe, but then it never grows from there. And as investors, we've all had lots of portfolio companies like this, right? So I think it's super important as you're thinking about the market and the business that you want to build, that of course, it's important you're passionate about it, but it cannot be a passion project if you are expecting venture scale. You need to really think about distribution as one of the key pillars. And if you don't have a vision for how you can get this distribution, it's really tough, right? And coming from a gaming background, we're more obsessed with data than anyone. Like at King, there were probably 100 versions of Candy Crush running in parallel at any given point in time, and everything was being measured, so we knew, or they knew, by day one, by day two, if retention wasn't great, it wouldn't work. And the whole innovation there was the freemium model. So you can actually make an app available for free and get people hooked, and then you finalize, or you basically find a way to monetize the whales and let everybody else play it for free, because customer acquisition in the App Store is so expensive if you're acquiring paying users that you literally, it's really, really difficult in today's world to buy yourself to scale in the App Store. So figuring out a way to adjust the model so you can get distribution without having to pay for it is critical. And almost in any sector for tech companies, maybe slightly more consumer than B2B, you need to have some secret sauce that makes you better at selling and getting distribution to win.
Yeah, I love that. There's probably two things that I'm kind of going back and forth on and reacting in terms of advice to founders on how to improve their odds of success. I think the first is probably team. And again, this isn't to say that you necessarily need a co-founder. There are about 15, 20% of unicorn level companies that are solo founders, but you need exceptional team, and that tends to be universal. And so having the right people around the table who can execute and execute at a very high level. And so thinking through what are those complementary skills, and is the team really calibrated to A-level performance? It's really difficult for certainly first-time founders. As you gain experience, it's easier. It becomes a little bit easier for you to surround yourself with exceptional people, but exceptional people tend to perform and do exceptional things. And so team is definitely one of those things. And so certainly as an investor, I look for not just the CEO, but are they surrounding themselves with people who are equally as impressive? The second is definitely timing. And so timing is one of those tricky things because to some extent there's certain things you can control, but there's certain things you can't. And timing may not be one of those. But as a founder, picking ideas or picking products that it is their time in history to be made. I was at a panel last night with Mark Maples, well-known investor, and he really said, like, why is now the right time in history for your particular company to exist? What is the new innovation that happened in the last 3 months, 6 months, 12 months that allows you as a startup founder to outperform some of the incumbents who, maybe this wasn't around. And so right now I'm spending a lot of time thinking through what I call AI first companies that could only exist because of some of the technology revolutions in AI. So again, I'd say team and timing are the two things I would definitely encourage founders to think about.
On timing, it's interesting because I think you're always on a ticking clock in the early days because you're always almost out of money or out of capital, right? So managing your time well is super important, and getting feature creep and building all sorts of things that you think you need to build in order to succeed, which in parentheses is often something your investors are pushing you to do if you raised a lot of capital, is often a problem. It's succeeding as a founder is a lot about saying no to things that are distracting you, both in your personal life, but also in terms of features that you want to build. And I founded a company with a very experienced CTO, co-founder of Dubsmash, and he forced our team to always, find ways of proving that this feature was worthwhile building before he would write any code. So whether it's on paper, whether it's endless interviews with customers, prove it. Because whenever you take the tech team aside and have them build a feature, it could be anywhere from, a couple of weeks to 3 months, and they cannot be building other things while they're building that. And you're burning $100K a month, for example. All of a sudden, you see time becomes essential. Focus and time and saying no to everyone around you that are trying to distract you.
Yeah, I love that. It reminds me of a story founder of Kayak, Paul English, told me, where he would put up links on the website kayak.com that didn't actually lead anywhere. There were 404 links, but he would just look through the logs to see if anyone actually clicked the links. Again, kind of rapidly iterating. And I think it's that speed to execution, speed to learning that's definitely super important to founders. So let's ask another one. And so, as we look at data, and we're all data-driven investors, how do you ensure that data that you rely on for decision-making is accurate and free from biases? Christian, you want to kick us off?
Well, first of all, data shouldn't be a crutch. I think you cannot, certainly the earlier you want to invest, the less data there is. Certainly kind of quant data, it becomes much more subjective. So if you're kind of relying on some key metrics and, you must answer these 10 questions in a certain way for us to invest, you'll miss lots of really important founder opportunities. But I think I would also say don't just trust third-party data, because third-party data may be outdated, or it may be, it may have been done by someone with a different agenda than yours. So primary research and going out and spending lots of time with customers is key. And even as investors, when we're evaluating companies, if we were to just trust what the founder is telling us or what the industry is telling us, we would be making lots of mistakes. You need to use critical thinking, and then you need to find ways of proving that this data is still accurate, or whether it makes sense or not. And compared to when I started building companies like 15 years ago, there's so much more data available now, and you don't have to pay like tens of thousands of dollars for a lot of this data. There's also a lot of collaboration amongst startups. You have Reddit groups. I mean, you have open source, files on GitHub. I mean, there's so much data that you can dive into to validate your hypotheses before you're making decisions.
Adam, how about yourself? How do you make sure that data you're looking at isn't overly biased?
So I think that there's a lot of people who want an out-of-the-box solution where they're not super budget constrained, but they're happy to say, if I pay you 6 figures, I just want to have an amazing data set out of the box that I can train a model on, and it will do the heavy lifting for me. I think to really have purity of data, you need to put that data set together yourself, and you need to go directly to the sources of that data, as Christian said, rather than trying to rely on someone else who's aggregated it, and potentially, use some sort of, tool to fill in the mean where there's a blank, and therefore you think it's a real data point, but actually it's just a model implied data point. The only way for you to know that is to put the data together yourself from actually the source. But I think more broadly, in terms of early stage investing, no matter how good your data is, most of the signals are founder level signals. And founder level signals will only get you some of the way there, because there's only so much you can model. There's only so much on the internet. And a lot of these deep personal factors about someone's motivation, or whether they have a chip on their shoulder, or what their childhood was like, or their motivations for wanting to succeed, are existing nowhere but in the head of the founder. So I think that the data-driven side, in terms of predicting outcomes, should only be a voice in the room, and it needs to be augmented with the human insights, with the human gut feel, because I think the tech and the humans together probably need to come together the earlier you are to make that decision. And you can't have a fully automated data-driven investment process for a seed or pre-seed funds, no matter how pure your data is.
Julia, what do you think?
I mean, I think both of you guys summed it up pretty well. I think it's important to gather information from multiple sources to create that more balanced view, not just to rely solely on the data, not just to rely solely on the humans, but to create an augmented approach to your decision making and your judgment, I think is really the way to go.
Love it. I know for us as well, looking at data, when we dove into the data, we started to see that there wasn't even sampling of some of the data points that we were collecting. And a very simple example was, we started with a data set that we collected of post-exit founders who had a high degree of success exiting, 8, 9, 10-figure exited companies. And we started to realize that our data was undersampled for female founders. And so in some cases, to improve the quality of the data, we went out and specifically targeted, survey information from a more diverse data set. So again, being kind of self-critical of your own data and just making sure that you are filling in the data where you do see holes. And I love the comment that if it's not your data, if you're getting it from some database or a spreadsheet somewhere that you found, like, how do you know it's really represents the things that you thought? So
also the way that you manage your own data and your own decisions, you need to periodically review it. So once in a while, like even when you're building a portfolio construction as a firm, you're saying, I think I can get this kind of ownership with this kind of check size. Well, 6 months later, check in. Are you actually getting that? Update the model, course correct along the way. And it's exactly the same when you're looking for data for like investing, or if you're a founder, you're looking for data for making decisions. Was that data correct? Do I update it? You should be getting better every quarter, getting better and better, using the data and improving on it. It's not like a one-time fix.
Yeah, I love that. We are getting some questions from online. So if you are watching us live on either LinkedIn Live or YouTube or after the fact, definitely feel free to ask your questions. And Amjad asks, how is emotional IQ measured? And I think this was a comment for Julia, because I know you were thinking about emotional IQ.
Yes. So there's technology out there that is starting to measure it. In our technology that we're building, we're leveraging actually research from a Stanford professor and using what's called the Big Five personality traits and estimating the personality traits and certain personality traits that are significant to founders, like grit and ability to conflict productively. And when you, by putting those multiple personality traits together, you start developing a full picture, and then you can start digging in on where those flags are. And when you're asking them the questions, like, I see that you have really high chance of conflict. Like, tell me about a time that you as a team that you've run into some trouble. Or, I mean, that's probably a question that most investors already ask, but grit is a new personality trait that we're uncovering. So it's like, tell me about a time that you've pivoted, that you probably might not uncover necessarily through initial conversations, but you can use technology then to uncover these signals to start digging in deeper. The emotional IQ, we're not on that one yet in our technology, but the researchers are starting to measure it in long form surveys and things like that.
Love it. Christian, Adam, any comments on emotional IQ or anything that you guys have seen from a data side on emotional intelligence?
Well, if you're asking someone if they're emotionally intelligent, it's almost a rhetoric answer. So you need to ask people in their community that have interacted with them what they're like, So just like if you're hiring someone, you take references and you go out and you figure out what the situation is, and then you combine that with what the person is actually saying. There will be, and even references, like if a person is giving you their references, they will be highly curated. So you need to kind of go beyond that and figure out. I always love a good crisis because it brings out the best and the worst in people. So there'll be wartime stories where someone will either kind of have done really well or not so much. And then I think it's also in the conversation, like we work a lot with athletes as well, having the conversation about just like, do you have a growth mindset? How are you looking to improve yourself? What matters the most to you? How have you, overcome some of the biggest challenges in your life over the last, few years? And then the way they answer those questions will tell you a lot about how much is about me, I, versus how they interact with their surroundings.
Yeah,
I would say there as a caveat that some of the most successful tech founders would fail every EQ test. I mean, they are breaking things and they don't care, right? So I think it's more around you need to get a sense of the entire team, like founder team. So we have a questionnaire that we use when we're interviewing founders, not like super strictly, right? But we've actually had the founders of 10 unicorn companies score themselves and their co-founders on this, going back to the time that they started their seed. And it's very honest. So we can kind of see what are the kind of combinations of skills you get within the founder group, and you can see, well, this can actually work depending on how they are distributing roles between them and how they solve conflict amongst themselves. So you need to understand this context. There's rarely a simple answer, yes or no.
Yeah, it's interesting on the emotional intelligence side. One of the things that we've certainly observed in some of the research is that exceptional founders tend to be a little bit neurodivergent. There's certainly research that ADHD is highly prevalent. Folks may have elements of bipolar as well. And so some of that may be the founder's greatness. It can also be an Achilles heel, but it allows them to push themselves and their team to places that maybe more typical human would have trouble going.
Sorry, we just wanted to add one more thing to that. So the reason that this is so important, though, is because the data shows us that the number one reason for startup failure, which is 6 out of 10 failures, is because of the team and team dynamics. So having that emotional intelligence, at least within your company, to handle conflict, that's really when the rubber hits the road. Doesn't matter if you have a great idea or great technology. If your team can't get along and stay in the same room together, then everything's going to blow up.
I agree. That actually correlates with some of the stuff that we've seen. That one of the predictive things is that if your team has actually, if you and your co-founder have let each other down, that's actually a positive thing. If you've been able to withstand that trial of kind of relationship, because startups are hard, and when the going gets tough, if the founding team's going to break up, that's going to happen. You're going to have complexity in your startup journey. And so if you can't have resilience over some of those complexities, it's just going to be difficult.
Yeah,
Awesome.
I think most founders are blindsided, as are we investors, when their co-founder throws them under the bus. And there's so many examples of this. I've been building businesses for 20 years, and last 10 years primarily with founders, and co-founders that seemed like they were like made for each other ends up throwing each other under the bus. It's just really difficult, right? And so you have to, and even like from as an investor, we're very worried about long-term outcomes. And if a founder leaves and all of a sudden 20% of the cap table is no longer active in the company, that's a big problem, because how can you then recruit new people and incentivize them? So there are quite a lot of things to think about when it comes to founder dynamics, not only kind of emotional intelligence, but it's almost like a commitment that everyone needs to have to each other to play by the rules.
We were meeting a US fund probably a year ago, and they said one thing they always do before they invest, they would take the founders out to dinner, and it's always sharing food. And they said, you look at who goes first for the food, who goes last for the food, who's willing to sort of share the food with the person next to them. And it seems so innocuous, but they have done this for decades. And they said, we're not going to tell you what we found, but we can tell you that actually there's quite a lot of signal just in seeing how a founding team behaves at the dinner table, which I thought was really interesting.
That's fascinating. It reminds me of an interview question when I worked at Microsoft. It was, is this the type of person that if you offer them a glass of water, they'll leave it on the table, or will they clean up after themselves? And they found that the folks who are caretaking for their environment as well were more generally mindful of those around them, which was kind of similar, like this innocuous signal that may tell you more than you think. So let's jump into the next question here. So, we're obviously looking at data in venture capital, but what are some of the limitations of using data, and how do you account for some of those limitations? Julia, you want to start us off?
Yeah, I'll jump in. You actually kind of alluded to this already, Greg, in one of your earlier comments, that if we're drawing conclusions based on historical data, and that data comes from a business culture where people treated people differently based on color and gender and where they've been in the past, then we have to take that into account, that data might not necessarily be reflective of our current environment and our future environment. And so to gather and mindfully add in additional data sources like you did, I think is really wise.
Adam?
I think just going to one of the earlier points I made, but like the earlier you go, the more blind spots you have, and most of the data is founder focused rather than necessarily company focused. So you're going to miss a lot of the signal in terms of what you can capture, in rows and columns on a spreadsheet or in a database. So I think it's understanding that the earlier you go, the more the decision will still be made by the humans, but it's just the data augmenting that, and the data is a voice in the room rather than some omniscient black box that tells you yes or no, and is the sort of be all and end all of whether you back a company or not.
Awesome. Christian?
It's very interesting. I recently analyzed, I kind of dissected what the top decile early stage funds have in common, and I discovered that the best performing funds, early stage funds, tend to be specialist funds. And if you're a specialized fund focused on a very well-defined industry or problem, I think data is actually, you can make a lot of database decisions because you understand exactly what good looks like versus bad. And if you're a generalist investor, you are per definition not an expert in most of the bets that you're making, and you rely, on secondhand information quite a lot. So I think my point here would be that there are much greater limitations of using data as a generalist fund than as a specialist fund. And I think one could even argue that's one of the reasons that specialist funds tend to outperform.
That's fascinating. I think as you guys say, it's data is one aspect, but certainly the thing that data sometimes won't tell you is the experience. And so certainly from a venture perspective, I often tell investors that at the end of the day, you're investing in the experience of investing and helping early stage companies, and certainly investing in helping early stage companies informed by data is better than not informed by data. And so, I think it's a partnership between kind of, I don't really want to be a purely algorithmic trader or investor. I think there's a human component to really understand the nuance and to guide the startups, because there's unfair network advantage and connections that you can make from both a founder and operator perspective that may not be inherently visible in the data as well. Let's jump into, if you're all looking at data, I'm looking at data. If an investor currently isn't using data to inform their investing decisions and choices, what might be a good kind of easy entry point to get started? Christian,
I think there are lots of great investors out there that are using data, and I have learned everything that I know about investing, partly from building companies myself, but certainly by building relationships with some of the best investors out there that are very data driven. So I think aligning yourself with friendly co-investors and learning what works for them, it might be 1 or 2, or it might be 5 or 6, I think is a great way to start. Bigger firms will also be investing a lot more in using data, so they will have looked at a lot more different solutions and can help kind of jump the queue and help you qualify what's going to work best for you.
Awesome.
I can add to that as well. So I'm a big fan of Dr. Andre Rederath's newsletter called datadrivenvc.io. He's got wonderful information about getting started, and he was one of the first, I think, data-driven. He was definitely the first to start gathering information on the DDVC landscape. But his basically thought leadership recommends that if you start, there's a roadmap, yes, no. First thing, get general partner sponsorship. If you can't do that, it's going to die. If you can, then take a look at your fund size, and that'll basically dictate your resources available. So for funds that are greater than 200 million, the recommendation is to do a combination of build your own tools, gather your own data, and buy. But then if your fund size is less than 200 million, then his recommendation is just to buy. And there are a lot of tools out there available. A leading startup database right now is called Spectre. One of the top deck analysis tools is called DeckMatch. Moneyball that we're building is the first tool on the market to automate analysis of founders and teams. So there are tons of tools that are now coming available on the market to really set up that tech stack. But you got to start with the general partner buy-in first, of course.
So we have a question here. I'll go this way so you can see it all, because there's a lot here. Given the difficulty in teasing out causality from correlation in the data and the extra noise generated in moving from a theoretical causal link between the trait and the future performance to a practical quick test of the trait. So let me summarize. How predictive do we really think this can be? Put another way, what proof is there that taking this sort of approach generates outperformance on a portfolio basis?
So I'm happy to jump in on this one. I think so. People ask me this question all the time, and they say, okay, you think that, we found that MBAs were less likely to raise money. So people say, how is that causal? Is that not just correlated with something else? What I would say is it's not about the individual variables and whether one is or isn't predictive necessarily, because ultimately you're taking all of that data, you're hopefully putting it into a model, and that model is giving you some sort of output. you can back test that output and see whether there is skill or not over whatever time period you choose. So from a pure investment decision perspective, ultimately what you're looking for is hopefully a model that says either yes or no, or a score from 0 to 100. Whether you decide to invest on that signal or not is up to you. But in aggregation, regardless of whether it's causal or correlation, there is still predictive power, and you can backtest that predictive power. So it doesn't necessarily matter where that power is coming from, as long as in aggregation you have the data and you can draw some sort of output from that data.
I think the more predictive the data is, the higher the valuation, right? So what kind of investor are you? Are you looking for, lots of predictability? Well, then you are not an early stage investor, right? So if it's most of the data, if you're a pre-seed or seed stage investor, there is it's at best a 50-50 shot if this founder will work out. If it's a first-time founder, chances are smaller, but valuation is smaller. If there's a serial founder, less risk but higher valuation. That's just how it works. So I think you need to figure out what game you want to play.
I think that's totally right. And kind of the analogy I usually draw is in very late stage public companies, right? There's definitely quantitative analysis and financial analysis, and folks who will crunch the numbers on public S&P 500 companies, and they can show performance of their funds investing in a quantitative way. You can continue to go earlier and earlier, and there's certainly PE and growth stage funds that use data-driven approaches to improve portfolio performance. There's really no reason why that modality of using data to improve performance doesn't work earlier. And so similar to what Adam said, in aggregation, these things will work. It's just looking the data and dissecting it the right way.
I think you need to be disciplined, right? As a VC, you're looking for these outlier opportunities, right? And if you're not super active in the market and you're only looking at 500 deals or even 1,000 deals a year, your chance of seeing enough of those crazy outliers are just too small. I invested in a very interesting business many years ago, in the sports media business, and they were raised. I basically led the seed round, and at that point they had spent $400K on buying the top 100 Instagram handles with sports highlights. And they had paid $400K for buying that, and they were getting close to 1 billion monthly page views of third-party sports content. And it was very obvious to us that by just growing that and launching a simple ad model on top of it, they would get their money back within 12 months. So, and as I said before, distribution is so important. If you see a startup and you're writing them $1 million check for 10% of the business and they have 1 billion monthly page views, then they've hacked it, right? But these are, you don't see these very often. So predictability of success when someone have cracked distribution is huge, right? And if you can get in on a good valuation, so much the better. But you have to see lots of companies and be very, very critical about them having to have something that's really different and really unique. Otherwise, if it's just a serial founder who had an MBA, that is a very small predictor of this becoming like another unicorn.
So we have another question coming in from Philip. I'll go ahead and read this. Taking an NLP approach, do you see value in analyzing founding narratives or narrative compositions? The idea is deeply rooted in identifying the opportunity was recognized in prior professional positions when evaluating investment cases. And I'll let Adam start, because I know you've been analyzing texts and comments and things of that nature as well, right?
Yeah. So it's tricky to know. You want to watch out for reverse causality, where you're analyzing some sort of text that was written after someone had already raised XYZ. So we did our best to control for that. And again, causality is hard to establish, but we did find that running written text on thousands of founders and pulling out big 5 personality traits For example, if there was a strong neurotic trait, they were twice as likely to raise either an A or a B round as someone with, the opposite way around. If they had a strong neurotic trait, they were half as likely to raise as someone who wasn't neurotic at all. Or founders that displayed agreeableness traits were more likely to raise, which maybe isn't super surprising, or extroverted founders were more likely to raise, which maybe isn't surprising, but the data did seem to support it. Now, we were using a third-party API to essentially analyze the text, which I think is okay. But it took 4 or 5 years to run that through a huge number of profiles and Twitter accounts. So what we're not quite sure what it means, but there is some sort of signal there, at least based on what we've looked at.
Very cool. So we'll do this as a last kind of pre-baked question. If folks listening have other questions, definitely put them in the comments on LinkedIn or YouTube. We're happy to take 1 or 2 more. But to kind of start to bring us to a close, what are some of the things that you've seen in the data that is perhaps counterintuitive, and maybe you were scratching your head, but you kind of keep seeing it in that particular way? Christian, you want to kick us off?
Yeah, I mean, going back to this unicorn founder DNA study that we published back in April, I was quite surprised to see, how many of the unicorn founders in the last decade were kind of Mark Zuckerberg types, white male, privileged, boarding school, Ivy League university. They who started like right after college, that's like 10% of unicorns. So these people are obviously exceptional, but it's only 10%. And if you then looked at, I was also really surprised by the fact that over 60% of unicorn founders in the US were immigrants. I know that there are quite a lot, and everybody said, "Oh yes, we know that," but 62% is quite a lot. And then one thing that I was pleasantly surprised about was that last year, 15% of new unicorns in the US had a female co-founder, which is great. It's still, far below what it ought to be, but compared to Europe, where it's like 2%, 15% is great. And it has gone up from, single digit percentage 5 years ago to steadily going up. So we might see quite a change over the next 5 years on that matter. But what's also interesting in that is that there are more European female unicorn founders in the States than there are in Europe. So if you're a female, highly ambitious European founder, you're probably better off going to the US.
Julie.
Actually, I was going to cite the same same numbers that I think a lot of the capital placement isn't necessarily reflective in the data yet, reflecting the results of the data that, female-founded businesses are 62% more profitable that have at least one female founder, yet they're still receiving, less than 6% of venture capital. So I guess what's counterintuitive for me is why the money isn't following the returns and why the money isn't following what we're already seeing in statistically significant results.
Adam?
Yes, so there's 2. I think that the first thing is there's so much of a sort of a dogmatic approach to co-founders in VC, where people are almost unanimously told, listen, if you want to start a business, you need to do it with someone, because the fact that someone else is willing to drop their job and take that risk and do it with you gives your idea more validation. And there is some truth to that. So the numbers say, I think 60% of unicorns end up having 2 or more founders. But you flip that statistic on its head, and what it says that 40% of unicorns were actually done by a sole founder. So, if you had a strategy that's only focused on sole founders, still there's a pretty decent chance that with a few predictive signals, you can probably pick winners. So I think it's small things like that where a statistic at face value might seem like actually there's something there. Turn the statistic on its head, do 1 minus that value and see what it says. And actually there's something that's counterintuitive, but is something that is tradable. And that sole founder bias to me is always incredibly odd. And the bigger and bigger the companies get, the less and less the number of founders is relevant, which is really interesting.
What's interesting is that what we saw when we looked at, looking at all the unicorn founders in the last decade, we saw that the solo founders were a little bit unusual. it was kind of, they were unusual, meaning a lot of them either didn't go to university, they were not in the founders circle at all, they didn't consider themselves an entrepreneur. They started like an e-commerce company and it kind of grew, and it took a long time for them to build it. Or they had like a PhD in like biotech, and they were like masters in this one thing, and they've just been building companies like all the time. Your typical manufactured founder who has read all the books and done all the right things all along, it's much less common that you find solo unicorn founders among them. They tend to be a little bit different when they're solo founders, if you look at the data.
Awesome. Well, to kind of close us off, we're going to do maybe 1 or 2 minutes from each firm, just in terms of what they're looking for, or how founders can get in touch. And so my name is Greg. I'm with Founders Edge, and Founders Edge is an early stage firm. We focus on investing at the intersection of user experience and artificial intelligence. And so also a data-driven firm. We really think about the psychographics of founders and how to give founders the right advice. We're called Founders Edge because we believe that founders are the unfair advantage to future founders, and we're here to help those types of companies.
Whoops.
I can go. You want me to go? Yeah, so I work for Episode One, guys. We're an early stage investor, seed and pre-seed in Europe. So we do 1 to 3 million checks in B2B SaaS companies, but very generalist within B2B SaaS. So anything from quantum to robotics to comp bio to productivity tools we look at. But as long as you're a reasonably technical founder with some unique degree of founder market fits, and you haven't raised any institutional money yet, we're happy to take a look. You don't need to have a product. Sometimes you don't even need a pitch deck. We've done pre-pitch deck deals, but we're mainly founder focused. So 80% of our weighting is on the founders. So if you fit the above, we'd love to hear from you. Drop me an email or a message on LinkedIn.
And I'm Julia Whippo, co-founder and CEO of Moneyball. We're using AI to reduce friction and increase data availability between early stage investors and founders. We're using a unique approach with AI agents and tools to generate proprietary data sets that enable both sides to make better decisions, reduce risk, and increase returns. And if you're an investor who's looking to capitalize on these trends of data-driven availability in venture investing and private investing, we are raising in our pre-seed round. We're doing quite well, so please contact me soon. And if you're interested in capitalizing on our insights that we're building, we're starting with, everybody says it's all about the team, and it's the number one reason for startup failure. So we thought it was time to upgrade how team diligence is done, automating team and founder diligence. So please reach out if you're interested in signing up for our wait list or being an early adopter of our tool.
I'm Christian Dorfer. I'm the founding partner of Defiance Capital. We are pre-seed and seed stage investor in the US and Europe. We are particularly interested in founders who have an insight into a market in the B2B space that is kind of not covered by existing solutions out there, and they're super passionate about solving it. We like technical founders, and we like founders who have a history of doing really impressive things, often against the odds. So if you have been building since you were a teenager and you're really hungry and you want to take over the world, or maybe you arrived to wherever you are now in a suitcase and had to take care of your family at the same time, and now you're at a point where you're starting a new business, we find that super impressive as well. So we'd love to hear from you.
Awesome. Well, everyone, thank you so much for joining us today. If you're interested in data-driven investing, definitely leave a comment, definitely reach out to us. And thank you so much, everyone, for joining today. Appreciate it.
Thank you, Greg, for having us.
Take care, guys.
Much.
Yeah, bye.